So welcome to the latest in our Retire Abroad Virtual Roadshow webinar series. Today, we aim to give you an idea of some of the financial issues that you should consider as you plan your retirement to Europe. Failing to plan can be financially very expensive, although everybody's situation is unique, and professional advice is essential from someone able to look at the consequences in the UK as well as in the country that you're moving to. There are a number of general principles and detailed rules that you need to be aware of, and we aim to sort of cover those in outline today. I'm Nigel Ayres. I run Expat Network. I've lived in Hong Kong, Malaysia, the US during my career, and lived in Spain for the last 3.5 years. We're joined today by Jason Porter of Blevins Franks. So one or two of you have indicated that you are interested in other countries than Spain, Portugal, and France, Italy, Greece, Cyprus, and Eastern Europe. We will not be covering those countries today, but if you need any assistance or have any questions, please email us at expats@expatnetwork.com and we'll put you in touch with someone able to help. And so also, just before we start, just note we're here to answer your questions. So please use the buttons on your screen and submit any questions you may have. We'll answer all that we can during the session. Any that were not answered during the session, we'll answer by email after the webinar. And we're also very happy to introduce you to our network of service providers, carefully selected, to give you any sort of assistance you may need as you plan your move. So over to Jason. Perhaps, Jason, you could start by giving us a little background on yourself and on Blevins Franks.
Oh, hi there. Good afternoon, everybody. My name's Jason Porter. I'm the Business Development Director with Blevins Franks and have been for the past 8 or 9 years now, I think. My background is I started out as a chartered tax advisor with a small accounting firm out in Essex. Then from there moved to Coutts Private Bank in London, where I also became a qualified financial advisor as well. And that's one of the important things I think that we try and do within our company is incorporate both tax and the financial planning side of things into all of our planning. So there's no divide down the middle. There's no exclusion of ideas. I joined, as I said, 8 or 9 years ago. I've worked at Coutts, I've worked at Credit Suisse and various other organisations as well on the finance and tax side of things. Blevins Franks is an organisation or a company that's been around for approaching 50 years. We started out as more of a kind of tax operation, helping people that had moved abroad from the UK with their tax affairs. And we've gradually morphed into an organisation that's covered France, Spain, Portugal, Malta and Cyprus, dealing with their tax and financial planning affairs, and the kind of interaction with the UK as well, which is an important area of understanding, as you could be doing certain things from say a French perspective, but not dealing with the UK angle as well, and sorting things out there. So our expertise is across all of those jurisdictions and the interaction with the UK. We have something in the region of 23 to 25 offices across Europe. We're in most of the main areas where UK nationals prefer to retire to and live. You can find one of our offices, or if not, then we're a relatively short car's drive away from coming to see you.
Okay, thank you. Right, well, let's start off with the dreaded word Brexit. How has Brexit, have they changed anything in terms of retiring abroad?
Brexit has, obviously, with all of the build-up beforehand, it appeared that it was going to be almost the end of the world from the UK leaving the EU. The actual real impact is relatively minimal. The main thing is from an immigration perspective, you will see that the order of events or the order of process for you to be able to move abroad has changed somewhat. It did used to be that you could pretty much move when we were part of Europe, when we were in the EU. You could move and then sort out your residency permits at some point in the future. There was no immediacy to get a visa or get a residency permit at the outset. That has now changed. You're only able to spend up to 90 days in the Schengen zone before you would have to return to the UK, and it's only 90 days in any rolling 180-day period. So it may well, if you spend 3 months in the EU, be another 3 months before you can return. So that's the big point. If you want to stay longer, then you do have to go and arrange an appointment with the consulate of the country you want to go to. You have to obtain a visa by completing an application form and various pieces of backup documentation, mainly in relation to your financial resources. This is all in respect of retirees that are people are moving who aren't going to be working. You have to provide them with financial background in terms of proving that you're not going to be a burden on their social care system whilst you're there. So it's proving that you have either a certain level of income or a certain level of, shall we say, wealth to be able to support yourself whilst you're there. That will generally get you a visa, and once you're there, you can, if you're staying long enough, extend that into a residency permit. Generally, the first one would be for 1 year, and thereafter you're renewing from anything for 2 to 3 years upwards until you get to 5 years, when you can then apply for a permanent residency permit, which is valid for 10 years in normal circumstances. So that's the main change. There have been the odd other change as well around perhaps the rate of capital gains may have gone up slightly in some countries because we're no longer part of the EU. We're classed as a third state in respect to the EU. There are a few changes that have come in from a Spanish point of view, which we might go into a little bit more detail later on in respect of pensions and wealth tax. I can't hear you. Your voice is gone.
My apologies, forgot to unmute. Complete incompetence. Sorry about that. So what are the 5 things that are important for people to thinking of retiring to Europe to understand?
Oh, the 5 most important things. Well, obviously the immigration, which we've already gone through, is probably the most important thing, because you can't move there for more than 3 months unless you've got a visa, and then unless you convert it to a residency permit once you're there. So that's probably the most immediate thing that you need to sort out. It's then looking at things like perhaps your main home in the UK. If you're going to be buying somewhere abroad to move to, are you going to be selling the main home in the UK, and when will you be doing that? If you're doing that before you move, then perfectly fine. It's all just under the UK rules. But if you're retaining that property for a little while, and that's something we see an awful lot, where people keep hold of their UK property because they're unsure how well it's going to go when they move, they quite often hold on to that for a number of years. Well, if you're selling that once you've taken up residence in that other country, then you have to look at it from a capital gains tax perspective from both the UK and the new country's perspective. So you have 2 sets of capital gains rules to accommodate and understand and see where you're going to stand. And most European countries don't have the same rules as us around main home reliefs. We have principal private residence relief, which in most instances will mean that you don't pay any capital gains tax on your main home. In Europe, the rules are different. Each country has its own main home reliefs, but then generally not as forgiving as the UK's rules. So it's making sure you understand those and what your exposure will be should you sell that UK home 3 or 4 years down the road. That's one of the things you just need to be aware of. Probably the next thing is, are there going to be any taxes that you're not aware of from your own UK experience? So in countries like France and Spain and Portugal as well, there's variations of what we would call a wealth tax, where you might pay an additional annual small amount of tax per year based upon how much wealth you have, either in that country or on a worldwide basis. Now, it generally doesn't kick in until you're kind of at 1 to 2 million euros worth of wealth, but that can include a main home as well. In certain instances, it now can include a pension pot. So you're seeing that you can actually hit those lower limits quite easily and become liable to a wealth tax. So it's worthwhile understanding what kind of assets does it hit, mainly real estate, and will I be liable? What can I do to try and avoid that or plan for that? If you're going to be living mainly on pension income, then it's understanding some very, very simple rules. How will my pensions be taxed? So if I have different types of UK pensions, be it a SIP, be it a company scheme, either a defined contribution company scheme or a defined benefit final salary scheme. If I have a state pension, if I have a government pension as a government employee, how will they be taxed from a UK perspective once I've left, and how will they be taxed in the new country? It's understanding those rules, because there are different rules depending upon where you are. And then you have, are there any tax efficient things I can do that might improve my position once I'm in the new country? And there certainly are. In respect of a good few countries in Europe, there are ways that you can certainly use some of their lump sum rules to take either annual lump sums or one-off lump sums, which can be taxed at much, much lower rates than they might otherwise be at 20 up towards 40 to 45% that you would have in the UK. And in most countries abroad, there are special rates for certain lump sums that might arise. The other thing is that the 25% tax-free lump sum that you're allowed in the UK, if it was your intention to take that, it is always the case that you should take that before the UK, before you leave the UK, because it will always be taxed at 0% here, whilst abroad they don't have that exemption. And as most pensions, apart from government pensions, will be taxable in the country you're moving to rather than the UK, it's looking at those rules and seeing what's the best thing to do. And in almost all instances, you should take that 25% lump sum before you leave the UK. And then as opposed, apart from wealth tax as a new tax, it's then understanding probably if you're going to be retiring at 50, 55, 60, 65, somewhere around then, you need to start thinking about inheritance taxes, passing assets on. What can you do? Does it all have to go to children, etc.? The rules in Europe are different. The succession rules are considerably different than the UK. They do have what we would call forced heirship, where certain percentages of your wealth should be going to your children. So you have to be aware of that. What provision can you make for your spouse? And then what about children that have come from previous relationships, that kind of thing? It's understanding how that's treated and in what order they would receive assets from your death. How would they benefit from those, and what can you put in place to make sure everybody gets what you want them to in as tax efficient way as possible? You're on mute again.
I've done so many of these, and then I just go incompetent for a moment. So anyway, as people prepare to retire, obviously traditionally focus needs to shift from building your retirement fund to optimizing income in retirement, and that's true for anyone whether they're moving or not. And I think moving abroad presumably just adds a little bit more challenges. What are the key issues that people should consider for their investment strategy as they plan retirement abroad?
It's an interesting question, and I think, would your investment strategy change from if you were retiring in the UK compared to if you were retiring abroad? I don't think the actual investment strategy you would have with the underlying funds that might be in your pension fund would change, because if you're going to be shifting in retirement more towards income producing assets than towards perhaps gain enhancing assets, then you would do that if you were in the UK, or if you were living in, say, France or Portugal or wherever. You're still going to be adopting the same philosophy because you're still at the same point in your life. I think it's more so around, are there any tax planning ideas that I can do in terms of how I take that money out of my pension scheme? As in, should I take it as an annuity? Should I take lump sums? Should I take regular lump sums, or should I wind the fund up entirely because there is a particular tax break around that? And then if you are winding it up entirely, then obviously the responsibility is then falling on you as the individual about how you manage those monies and make sure that they are there still to perform the same tasks that they were going to do before, which is covering your living costs and any capital outlay that you might have in your retirement. So if you're putting those funds that might result from collapsing a pension fund, you might be putting them into some other tax efficient vehicle. You're probably going to be running those monies underlying in that vehicle pretty much the same as you would have done in the pension scheme, looking at income enhancing assets or income delivering assets, and managing it accordingly. Obviously, with the flexibility that you have either with a new investment vehicle or even with UK SIPs, which allow you so many different ways that you can take money out of the fund, either as a drawdown or as an annuity or a variation. The ability to draw down means that you could potentially retain the same investment philosophy that you've had throughout the fund, as in a diversified portfolio across the globe, looking to deliver income and gains, which obviously is a possibility. You don't have to flip over entirely into income producing assets. So there is a great deal of flexibility. I don't think how the style you would use would vary from remaining in the UK or moving abroad. I just think it's the options that might be open to you are wider now.
Right. Okay. So when people move abroad, obviously they become tax resident abroad potentially. Could you perhaps explain the rules that determine your tax residence in the UK and summarise the differences across the countries in Europe, or the main countries?
In the UK, the rules didn't used to be that defined, actually. It had more arisen around kind of case law and principles built up with the Inland Revenue. But a good number of years ago, they brought in something called the statutory residence tests, which lay down some fixed rules around when you'd be regarded as non-resident and when you'd be regarded as resident. Now, in most instances, for people that are moving abroad, certainly for the first few years, they would normally fall slightly outside of those, and therefore they would be looking towards the connections that they have with the UK and the number of those connections to determine the number of days that they can spend in the UK to remain non-resident. But the UK has always had what we call the 183-day rule, where if you're more than 183 days in the UK, then you are resident for that tax year. Over and above that, it did used to have a rolling 90-day rule, where if you spent more than 90 days a year in a rolling 3 or 4 year period, then you were resident. That rule is fallen aside now. It's more to the statutory residence tests, and then it's all about the connections, the number of connections you have with the UK. Which the more connections you have, the lower number of days you can spend in the UK without becoming resident. Now, in most cases, if you're spending anything less than 90 days in the UK, you're unlikely to be resident here. That would give you probably 2 connections that you could have, which would quite often be a property available for your occupation and having spent 90 days or more in the previous 2 years, which is why I always say for the first 2 years, the rules are a bit tighter. In terms of other countries and abroad, if you're visiting, France, countries like that, then you're looking at the 183-day test that's in existence across most of Europe. If you're there for more than 183 days, you're resident. Then a lot of them also have further tests which focus around something they call centre of vital interests, which is really if your family, your economic base is in the other country, even though you're under 183 days, then quite often those countries would say, we know you're under 183, but we think you're playing the rules. Your family is here. Most of your economic interests are in Spain or France or wherever. Therefore, we're going to deem you as resident here. So that's another rule that you have to look at. Most of these countries have those type of rules as well.
Right. Okay. Thanks. And so, is it possible under the rules to be sort of tax resident in both in the UK and in the country you're moving to?
Absolutely, because you can see the difference in those rules, that if you're spending more than 183 days in a European country, therefore you're going to be regarded as resident there. In the UK, if your number of connections to the UK is such that it reduces the number of days down, and you're spending, say, on average more than 90 days in the UK, then both countries would potentially regard you as being tax resident. And then you're falling into the tests that apply in the double tax treaty between the UK and the country you've moved to, and you're looking at then the strength of the connections, and you're going down a list of each of the different pointers as to which one would be regarded as the main country of residence. Now, that doesn't mean that it's going to say that one whole country then taxes everything, because it's all about the income that you have as to where they would be taxable. But if you're looking at, say, something like rental income, then in most cases it's taxable in both countries. If it originates, say, in the UK, but you spend more than 183 days in Spain, then it's taxable in the UK because it's there and it originates from the UK. But if it's also liable in Spain, and on that basis, the tax you pay in the UK, you can set off against the liability in Spain. So you should never pay double tax, but you will always end up paying the tax in whichever is the highest effectively overall. So if one is applying a rate because of the rate bands of say 20%, but Spain's applying 25%, then the 20% you've paid in the UK gets off again, the 25 in Spain, and you pay the additional 5 in Spain to take it up to the 25. So you can see that most cases, it's not the end of the world to be regarded as resident in both. It's an aggravation from an administration point of view, because you'd have to be preparing 2 sets of tax returns. Each tax year isn't the same. In Europe, you're generally looking at calendar years, the UK to 5th of April. So again, you're not looking at the same thing in terms of what you're declaring. And quite often you'll be out of pocket for a period of months while you've paid tax in one, but you're not able to set it off against the other, etc., etc. So it's that kind of thing. You also have to see things like, say, for instance, social charges in France, which is an additional layer of tax. It looks like national insurance from a UK point of view, but isn't. Whatever you pay under social charges in France, you can't set that off against the liability to tax in another country. It's an additional liability that can't be set off. So there are certain quirks like that which you have to be aware of as well to make sure you're not paying exceedingly high taxes overall.
Okay, thanks. And a good question from once you're a tax resident in a new country, do you pay tax only on the assets you have in that country? Or
most countries' rules say that if you're tax resident, you're liable there on a worldwide basis for both income and gains. If you're non-resident, then you're only paying tax in that country on the sources of income that you have in that country. So if you have a bank account in Spain, then potentially you would, but you're not resident there, and you would only pay tax on that in Spain because it's a Spanish source of income. Now, it's unlikely you'll pay taxes because it probably won't be enough interest to be liable, but that's the way the rules work. And most countries operate those rules. Some countries do have particular tax breaks, somewhere like, say, Portugal, which has the non-habitual resident regime. For the new arrivals in the country for the first 10 years have a preferential tax regime, which either excludes or significantly reduces the rate of tax on certain sources of income for the first 10 years in that country, even though you're a resident there. And then you'll have other countries like Malta, which will apply almost like a non-domicile regime like we've got in the UK. They can apply that for, say, UK nationals arriving in Malta. We'll get a specialist regime there as well. So there are certain quirks, again, around those rules.
So when you move abroad, do your UK investments remain liable to tax in the UK? Or
potentially they do, because again, the UK looks at it and says UK sources of income potentially liable in the UK. But what you do have is something in the UK called disregarded income. So if the income you have in the UK is investment income, you've moved to another country in Europe or anywhere, then if all you really have is investment income in the UK, like dividends, bank interest, rental income, that sort of thing, then your tax liability can be restricted to the tax that has already been withheld on it. So that might well be, a deduction of tax, the 10% rate that used to be on dividends, all that kind of thing. You're regarded as not having to pay any more tax on that from a UK point of view. So it's a special regime for non-residents. Now that can, again, work in your favour quite significantly, particularly for countries, as I said, like Portugal, where they do have a special regime for people that are for the first 10 years, where investment income then potentially isn't taxable in either country.
Right. So what about there are various investment opportunities, particularly government ones, which are tax advantaged in the UK, ISAs, premium bonds, and so on. Can you retain those tax advantages when you move abroad?
You can certainly retain the structures, so you can retain your investments in ISAs, although you shouldn't continue making them going forward. You should stop those. And in terms of premium bonds, you can keep the investment. But what I would say is it's the individual that we're looking at here. So if the individual is moving abroad, the fact that he might retain a UK tax efficient investment doesn't mean that investment remains tax efficient from the new country's point of view. The new country has its own rules. It looks at what you've got and says, well, how do we look at this from our own tax system's point of view? And when it comes to ISAs, countries in Europe don't have the same kind of regimes for that kind of tax efficient structure. So in effect, what those countries do is completely look through the structure to what you've got underneath. So if what you have underneath is investments, funds, that kind of thing, bank deposits, you will be taxed on in that new country any dividends arising, any interest payments arising, any bank interest, as though you owned that directly. So certainly the things that we see people doing is disposing of their ISAs before they leave the UK, because obviously if they've got rolled up gains in there, they can do that before they leave the UK without any tax liability arising because of the tax efficiency. When it comes to premium bonds, then any winnings that you might have on those would potentially be taxable in the new country's perspective, because they don't have a tax break around that kind of gambling winnings effectively.
Right. Okay. So are there generally investments in other countries that are tax advantaged in this way, or is that very much a British thing?
Most countries have some form of tax advantage savings. Most of them, certainly when it comes to European countries, most of them have. I don't know how viewers would understand the term, but there's something in the UK that we call offshore bonds or offshore life policies, which is really it's a non-UK life policy that really acts as almost like a tax wrapper around that investment portfolio, and it uses the life assurance rules to mean that you wouldn't pay any tax on the rolled up income and gains that's arising on that portfolio. You only pay tax when you actually make a withdrawal, but when you make a withdrawal, that withdrawal itself is taxed in a tax efficient way, so you pay less tax than if you'd own the portfolio directly. In Europe, they have exactly the same kind of structures, be they onshore life companies or offshore life companies, and that's one of the main tax efficient vehicles that you will see in Europe in terms of people putting away money and using that in the future to live off, drawing down off that fund and living off it. Certainly used hugely in France. Large numbers of wealthy people will use that structure as a means of holding their wealth in a tax efficient way. They also have particular benefits from a succession law perspective, in that they generally enable the policy holder to be able to put terms in the policy that allow them to distribute it to family members as an additional amount over and above they might be able to pass on estate tax free from that country's rules point of view. So there's a good number of benefits around those kind of structures that certainly that they use in Europe as a means of deferring tax and rolling up investments on a gross basis over a number of years to enhance their growth in Europe, something that's used hugely over there.
Right. Okay. We talked a bit about the sort of fact that things that might become taxable when people move abroad. There's clearly a need to sort of start the planning before you move abroad. Could you just sort of give us a bit more background to what sort of things that people should be considering before they make the move? I
think one of the things is, and we see a huge variety from the people that talk to us, become our clients. And some of them, we've got people that have come and joined up with us and become our clients beyond 5 years before they were moving, simply because they're of that kind of mindset. They want to understand the country that they've chosen, they want to move to. They may well have already bought a property there, and they want to understand how that property is treated from a kind of local taxation perspective. What council tax, what to some of the countries, if you're not going to be living there, you have to pay tax on an imputed rent for the property. Some of them want to understand, what if they were to die, how would that asset be passed on? What am I allowed to do? What the liability is going to be? But also, particularly when you're approaching, I would say probably 18 months maybe beforehand, and it's actually become probably longer than the original thing I would have said, more like 6 months. It's more like 18 months now, simply because of the amount of time it takes to put things into action now. And one of the big areas is pension planning. You know, if you look at myself, I've worked at probably 5 or 6 different companies. I have 5 or 6 different pension schemes. And it took, nowadays, that may well take anything up to 12 months to pull all of those together, perhaps in one overall SIP structure. If you have a defined benefit scheme, then you really do need to understand what's the rules around that, how it's going to be taxed, what is your pension going to be. If you are mindful of the rules around winding up defined benefit schemes, and obviously there's pluses and minuses around both of those. I'm not saying which way you should go, but it's understanding perhaps what the pension transfer might be on that kind of thing. But certainly putting pensions together takes much longer than it used to, because you know most pension countries now drag their heels, or they just don't have enough staff to be able to do this with the efficiency, the administrative efficiency they used to do previously. So it's certainly you need at least 12 months for that kind of thing. But then it's getting your head around all the rules. If you haven't bought a property yet, obviously you've got to make that decision about where you're going to buy. And when you look at somewhere like Spain, there's 17 autonomous regions in Spain, plus two kind of city-state areas, with each has their own set of tax rules, which allows them to vary the rates to a certain degree across income tax, across estate taxes, wealth tax, that kind of thing. So it's knowing what set of rules applies depending upon which area you're looking at buying in. So, it's understanding that kind of thing as well. I would probably say 18 months is the optimal time. That's not going to put you under too much pressure to be getting things in place and having everything ready by the time you go. 6 months isn't the end of the world, but particularly when it comes to somewhere like Spain, if you're doing things with your pensions, a recent a recent tax ruling in Spain basically says if you are pulling pensions together and moving them around, you really want to be doing that before you arrive in Spain, because potentially you could be paying income tax on a transfer. So you want to be sorting that all out before you go. And as I said, if it takes longer than you think, you could be holding up your move because you're still trying to finalise what you're doing with your pension.
Right. So when people go abroad, will they find the sort of tax systems broadly similar to the UK, or will they find taxes they've never heard of before?
Well, I think when you're looking at income taxes, then you look at the rate bands, you look at the scales and how they move. It's relatively similar to the UK. It's very understandable. There's probably a few more bands than there is in the UK. I think the UK we only have really 3, but abroad there will certainly be more. And certainly when it comes to somewhere like Spain, those bands can be 8 or 9 in depth. But the rates aren't a great deal different. Again, as I said, you have social charges, which can mean a heightened kind of social taxes in France. France, Spain and Portugal all have a form of wealth tax. But when you're looking at Spain, it's on a lot more investments than it is in France and Portugal, where it's just real estate. In Spain, it's on other investments as well. So you have to be aware of that. What is your wealth? Are you going to be liable to wealth tax? What can you do to plan for it? But probably the main areas that people will look at, particularly as they get older, is the estate tax rules and the estate tax rates. And the estate tax rules are that most countries in Europe have a form of forced heirship where you are supposed to pass a certain proportion of assets to children. That can mean that you can't pass everything to the spouse. You have to make specific plans for children from previous relationships, and you also have to be aware of other estate tax planning ideas which may be in place to allow you to pass those assets on through certain structures at reduced rates or at zero. So it's being aware of that. It's also being aware of the interaction of the rules between the UK and the country you're going to, because even though you're leaving the UK, it's highly likely you're going to remain UK domicile. Now, domicile is the defining rule for inheritance tax. If you're UK domicile, then you're liable to UK inheritance tax on a worldwide basis. Is there an inheritance tax treaty between the UK and the country you're moving to? There's not that many. Certainly there is with France, but there's not that many of them. Not like the 150 odd that the UK has in terms of income tax, corporation tax, that sort of thing with other countries, not for inheritance tax. Understanding interaction of the rules. If you're moving, then potentially you can fall back upon the EU succession regulations, which came in a few years ago, which do allow you to elect to apply UK inheritance tax rules to any will or to passing any assets that you have in the country you're moving to. So can take you out of forced heirship. But you have to be aware of, whilst you can pass the assets on to whoever you want, the liability you're going to have on those assets is to a huge degree still going to be determined by the country that you're living in, be it France, be it Spain or wherever. It's their rules in terms of the rates of tax you're going to pay. And if you're passing assets on to people that are either a long way down your connection, so as in you're getting further and further away from your immediate family, or you're passing assets on to a friend, someone that's not related to you, then you will hit very high rates of their estate tax quite quickly. So it's being aware of that. If there's certain people you want to make provision for that aren't children, that aren't parents, that aren't your spouse, then you have to be aware of the rates that are going to apply there, and be prepared for that.
Right. I know or I understand in Spain, the sort of inheritance tax rules are that the further the relationship away from you, the higher the rates become. Is that general across Europe, or is that very much a Spanish thing?
Very much the case. Very much the case that the further people get away in terms of whether there is a real bloodline to you, whether it's immediate family, then quite often either there's no exemption or the exemption is absolutely minimal, and you'll hit those highest rates of estate taxes much quicker, and you'll carry on paying them right through to whatever the level of the gift is that you're passing on.
Okay. You mentioned wealth tax, and wealth tax is new to most people, is that something that's in all countries, or and perhaps you could explain just a little bit more how that works?
It's not in all countries. Certainly the big three that we have that most of our clients move to, France, Spain, Portugal, there is a form of wealth tax. It's not called a wealth tax, it may well have a different name. In Portugal, it's called colloquially called additional IMI. It's like an additional layer on top of something called IMI, which is like a council tax. It's an additional layer on top of that for higher value properties. In France, it used to be on a much wider range of assets. It used to include regular investment portfolios, all that kind of thing. So your overall wealth would potentially be liable to wealth tax. They've narrowed that down in, I think, 2018. They narrowed that down to just being on real estate or shareholdings in real estate companies. In Spain, it's remained on a much wider base of assets. Effectively, the main exclusion in Spain is business assets or shares in family companies, that kind of thing, trading family companies. Most other assets are liable to wealth tax in Spain. So there is a wealth tax in those three big countries where most UK nationals tend to retire to. There are exclusions, and they vary depending upon what country, and sometimes they're based on the individual, sometimes they're based upon the couple. In France, the exclusion is up to 1.2 million euros. Then over that, you're liable. But then once you do become liable, your exemption falls to only 800,000, and then you're then taxed at rates. I actually wrote them down just in case people are going to be asked that question. The rate in France starts at 0.5 and hits 1.5% on worldwide assets of over 10 million. In France, you don't pay any wealth tax on non-French assets if you're a French resident, a new French resident, UK national moving into France. You don't pay wealth tax on non-French assets for the first 5 years. But after that, you're liable on a worldwide basis. In Spain, the rates of wealth tax start at 0.2%, but rise to a maximum of 3.5% per year over 10.7 million. So it's quite a chunky number. You've got exemption there of 700,000 euros per person and 300,000 on the main home per person. So if you have a couple, there's up to 2 million euros of exemption there. So again, it's at the higher end. Portuguese wealth tax basically you have exemption of 600,000 for an individual, but with a couple that's 1.2. The rate for an individual is 0.7, but once the assets are over 1 million chargeable, then it's 1%, and greater than 2 million, 1.5%. Rates are cheaper if the assets are held within a corporate structure. They start at 0.4, but you haven't got the 600,000 exemption. So you can see there's a variation of the rules. The one thing that most countries have is there is a maximum amount of wealth tax you can pay, and that is really based upon where the combined income tax and wealth tax liability can't be more than a certain percentage of the amount of income that you have, taxable income that you have. So the combination of those two can't be any bigger than a certain percentage of your income. So obviously, if you want to keep particularly real estate over and above the main home, then the only way you can reduce your wealth tax exposure is by reducing your taxable income, because your wealth tax, the only way it's going to be restricted is by the amount of income that you have. So the aim is to try and obviously have income tax or income planning as opposed to wealth tax planning if you're not prepared to sell down real estate assets. So that's certainly something you can do. And we talked about the offshore life policy. That is a means that you can use to reduce your income as well, because you're only taxed when you make withdrawals, and the amount you're taxed on is significant. What's deemed to be income is significantly less than the amount you may actually take out of the fund. So there's a very good way of planning there that works from both an income tax and a wealth planning perspective as well. One thing you have to be aware of again with Spain is that a lot of the autonomous regions were looking at reducing their wealth tax significantly because they had control over it. And, Andalusia had gone ahead in reducing its wealth tax, just like Madrid had done a good number of years ago, giving 100% exemption. And the government was seeing potentially a loss of revenues coming in. So they've introduced something called solidarity tax, which is basically controlled by central government. So the local regions don't have control over that. It's very, very similar to the wealth tax, but doesn't kick in until 3 million euros of wealth. But the exclusions and the reliefs around it are very, very similar. So again, you can do income planning to also reduce your solidarity tax exposure. If you have a wealth tax exposure, then any solidarity tax exposure you may have is reduced by the amount of wealth tax you pay, so you don't pay double. But again, as I said, you can plan and try and reduce the solidarity tax by income planning along the way as well.
Okay, thanks very much. So, I mean, it's always slightly questionable whether it's a good idea to entirely base your decisions on the sort of tax burden. But if somebody was looking to sort of choose a place based on which was the lowest tax burden and what was most attractive from a tax perspective, which countries would they be looking at?
I think before I say anything there, and it's one of those questions you hate getting, because actually when you're there and living there, and I've seen this myself from doing capital gains tax planning for people that were selling large UK companies, looking at ways of reducing that capital gains tax planning. And one of the ways you could have done that before was to have moved to another country and sold the company then and moved back to the UK. And one of the countries that almost used to stand up was Belgium, because it doesn't really have any capital gains tax. And a lot of people used to go, and then within 3 months they'd move back because they were bored out of their minds living in Belgium. So it's you should never let the tax tail wag the dog, I think is the phrase. You have to understand that you can only come back to the UK for a certain number of days per year, and therefore you do have to build a life for yourself in a new country you're moving to. So it's got to be somewhere that you're going to be comfortable living. And one of the things we say is you should always move there and rent somewhere to start with, perhaps during the winter season, when you'll see how many Brits there are actually living in the region you're planning on moving to. And then, the story I always hear is from one of our partners who was based in one of our southern France offices, where he said, he actually did that, but he bought the property in the winter and moved there when he found he had to drive 25 minutes to get a pint of milk. And it was just, he found it incredibly difficult during the winter when everything shuts down. So yes, I understand that tax efficiency is a very important thing, but actually enjoying yourself and enjoying your life is probably the most important thing. Okay, that said, you know, and you can kind of weigh this up, that if you're quite comfortable living on an island, you know, and the restrictions that's going to place upon you from, you know, entertainment, for culture and all that kind of thing, that you, yes, there's going to be those things there, but they're going to be in restricted number and restricted amounts. Then places like Cyprus and Malta are very attractive from a tax perspective, particularly if you're disposing of a business from you know, Malta being particularly attractive from that point of view. Particularly somewhere like Cyprus, if you've got a huge amount of pension income, then you can do various planning things there. But you are, you know, then struggling to, perhaps if you wanted to go on holiday to America, you might have to fly to a European mainland to get there, that kind of thing. And it's all that kind of stuff you have to take into account. Countries like Portugal, as I said before, has a very, very attractive special 10-year regime for new arrivals, which if you do have significant pension income or pension funds, and you were of the mindset that you were looking at drawing down upon them, then you can do that very tax efficiently at only 10% for the first 10 years. France, which everyone would think would be a very high taxing jurisdiction, partly because of the social charges that I was talking about, actually for retirees, if things are constructed correctly, can be incredibly tax efficient and can be a very useful place to be from a tax angle. Again, pension income, very interesting, and planning for the long term whilst you're there. Lots of very interesting tax breaks for you. So as you can see, there's lots of things you need to think about, and some countries you may not have originally thought of are actually quite attractive.
Okay, so generally speaking, obviously tax advice is important, and now we're sort of outside the EU. Is it still viable for people to retain their UK advisor, or what would you comment about that?
Well, one of the things that I used to be amazed by before I even joined Blevins Franks, I used to look at Blevins Franks and kind of think to myself, how do they do what they do? Which is, in the UK, there is this big division between tax advice and financial planning advice. Tax advisors deal with the tax advice, financial advisors deal with the financial planning advice, and you don't get a huge amount of crossover, even though tax is fundamental to financial planning. And actually, a lot of the tax planning areas that you used to be able to see have been closed down and loopholes removed. So, you know, everyone is restricted to a certain degree in what they can do. What I would say is that if you wanted to retain your UK advisors, then you're going to have to get advisors in your new country. A UK financial planner will not know the financial system in depth in the country you're moving to. He won't be qualified in that country. He's unlikely to be qualified in that country. He's unlikely to have the expertise or the authorization and registration that would be required in that country to act for you. He would only be able to deal with you over the telephone potentially, and then again, as I said, you're looking into potentially gaps in the advice that you're able to give. So, you know, there's restrictions there. In terms of, you know, what we have within Blevins Franks is we have a tax department, we have financial planners from both the UK and the other country's perspective, and one of our expertise is obviously over the last close to 50 years we've been around is understanding interaction between the two countries that you're involved with, the UK and the country you're moving to. That's why I think we're somewhat different from most firms. Retaining your UK advisor, you know, it's someone you might want to have in the background, but frankly, if you have an advisor for the country you're moving to, you're planning on moving there, you're planning on becoming a tax resident there, then in reality, your living expenses are going to be mainly from that country's perspective. You'll return to the UK for weekends and to see family. Then in reality, most of your living expenses, most of your costs are going to be in euros. You're going to be liable under that country's tax system, and therefore you're going to be arranging your affairs to be as efficient from a tax and a financial planning perspective from that country's point of view. That's the main country at the forefront of your mind. So in reality, you should be looking for an advisor in that country, but also an advisor that perhaps can help you understand the rules in the UK. If you still have assets there, you have pensions there or whatever, how those two sets of rules interact.
Yeah. Now, when people move abroad, they'll obviously be using different sources of financing, one of them being the state pension and the private pensions. In terms of the state pension, I guess I can explain a little about myself, that having recently applied. If you're in Europe when you apply, then you have to go to the international department and apply for the pension, and all of that is reasonably straightforward, apart from the fact that they tend to have a lot of backlogs. In my own case, I didn't hear it. You can fill in a form, but the beginning of the forms asks you, have you ever lived in England? Give every employer you've ever worked for in England. Give every address you've ever worked for in England. And is clearly not really intended for people who have worked all their most of their lives in the UK and then happen to be abroad when they apply. So by far the easiest thing to do is to actually pick up the phone and call them, and then they just go through a series of questions, and it's fine. The problem then I found was that 3 months later, I hadn't had any reply. And so I rang up, and the guy on the other end of the phone said, right, okay, nothing has happened to your pension. No processing has occurred at all. I'll put it on the urgent list. And 1 week later, it was all sorted out. So the message is, use the phone. If you don't hear anything, follow up with the phone, because you immediately get on the thing. And that's a personal experience, but also something that I've heard from various other people. So that's well worth bearing in mind. The other thing that is often asked is about inflation and the cost increase, the increases in the state pension. Currently, my understanding is that they will increase in the same as if you were in the UK. There are certain countries around the world where that is not the case. You know, a lot of the ex-colonial places and so on, Australia, etc., you basically have your pension whittled away by inflation, but that's not the case in Europe, but there's no guarantee that will always stay the same. Is there anything you'd like to add on the state pension there?
Yeah, that's just, it's part of obviously the agreement between the UK and the EU, where the UK left the EU. For those people that had left before 31st December 2020, they were obviously dealt with under the withdrawal agreement, and their inflationary increases were set in there. And then obviously once the UK had left, we got the further agreement with the EU, and again those inflationary increases are banked in there as well. It is obviously that agreement can be revisited, but at the moment certainly those inflation increases are protected, and it's likely that they'll go forward. I can't see a situation where they wouldn't be. In terms of the taxation, all the different forms of pensions, just so people know, the UK state pension falls to be taxed wherever you're living, not where it's originating from. So it's a UK state pension, comes from the UK, but actually if you're living in Spain, that's taxable in Spain, not in the UK. Company pensions, SIPs, that sort of thing, they're taxable much the same wherever you're living, not where they're originating from. And when it comes to government pensions, so for those of previous government employees, they always remain taxable in the UK, not in the country you're living in. So that's the one area that remains taxable in the UK. The only slight difference there can be Cyprus, which has a slightly different agreement in its double tax treaty, and where it can be taxable in either, depending upon which one you choose. What you do get with some countries is that even though the government pension may not be taxable in the country you're moving to, they may exclude some of the allowances and lower rate bands to effectively cover that amount. So you're not going to be taxed on it, but we're going to use up some of your rate bands and allowances for it. So you do get some of that going on in some of the countries.
Okay. We've got a question here from Maria. She said, is tax of pensioners on UK state pension in Spain? She's had conflicting information and amounts. Is it true that you don't pay tax on income or pension at under 12,000 euros in Spain?
Off the top of my head, I couldn't tell you because I haven't got the tax rates in front of me or the allowances. But there will be, much like the UK, an element of income that's either covered by their version of personal allowances, or with a very low rate of tax at the lowest end of their rate bands. So I suspect she may well be right, depending upon what the exemption is and what the allowances are. Okay. So yes, certainly the state pension from the UK is going to be liable in Spain if that's where she's living.
Okay, Maria, I'll get Jason's colleague Brett Hanson to sort of drop you a line in response to that after the thing. So moving then on to the property. Many people retain UK property when moving. What happens tax-wise if they sell it later on? I think you've touched on that, but just if we clarify that, and also the any rental income if they retain, how's that treated?
The rental income, as it's arising on a UK property, is taxable in the UK. But obviously, if you've got no other income in the UK that's liable, then you've got your personal allowances and your rate bands that can be set off against that before so you'll be paying a lower amount than perhaps you might have been if you've been living in the UK with all your other sources of income. It's probably going to be liable. Obviously, it depends on the double tax treaty between the UK and the country you're moving to, but it's highly likely to also be liable, the rental income, to tax in the country you're living in. But as I said before, the double tax treaty would normally say you can set off the tax from the UK liability against the liability you have in your new country. But again, be aware that potentially in somewhere like France, if you have social charges applying on that, that the income tax from the UK can't be set off against those social charges. And as I said as well, you generally pay overall whichever is the highest rate applying, which is probably going to be in the country you're moving to, because you'll have other income there to be assessed as well. So to push the overall rate up. In terms of capital gains, if you sell the property, from a UK point of view, it's potentially liable, and the new country's point of view, it's potentially liable. You always get this with real estate because it's a fixed asset. But in terms of the UK, we have the principal private residence reliefs, which basically say that all of the period, so you look at the whole period of ownership, and if you've owned it for 20 years and you moved to Spain 5 years ago, then you look at the gain that you calculate, and certainly those first 15 years of ownership, then you're only going to be taxed on 5/20ths effectively of the gain, a quarter of the gain potentially you'll be taxed on. There is another period of exemption, which is the last 9 months of ownership. That did used to be the last 36 months of ownership. That's been gradually whittled away and has very recently been reduced down to the last 9 months of ownership. So as you move out of the UK, if you retain that property for a good number of years, then there is going to be, over and above the last 9 months, a period of time that is potentially liable from a UK point of view. So you'll apportion the gain across it, and depending upon how big that period is, that'll determine how much of the gain you're taxable on from a UK point of view. From new countries' perspective, each country has slightly different rules. They all have main home reliefs to a certain degree, but really it's all about where you're living on the date you sell it. And in most countries, they have certainly a 12-month exemption. So if you move out and you sell the property within 12 months, you're unlikely to pay any tax in that country. Potentially, you have a further exemption of up to 24 months. And in most countries, you're going to get 24 months. It depends upon the circumstances. But then once you go beyond that, then actually, it's if you've moved out of the UK property, moved abroad, and it's been, say, 2 years and 2 months, then there's no apportionment like there is in the UK. It's where are you? What's the position on that date? I've been gone for 26 months. I've got 24 months exclusion. That doesn't matter because I'm 2 months over. I'm potentially liable on the whole gain. Now, there could be various other exemptions for the length of time that you've owned the property, but potentially you can be taxed on the whole gain, depending upon the circumstances. So that is something you really, really, really need to be on top of from the perspective of, if you want to retain the property just in case things go wrong when you're abroad, it's somewhere where you can move back to quickly, and then you can just sell the property abroad. You've got to move back to where you lived before, catch up on all your old friends, get all your old connections going, etc. It's nice and comfortable for you. But be aware that if your move abroad is a success, but you don't sell the property for a few years down the road, there is a potential liability there, and it could be sizable. So you need to understand those rules and know what the time spans are, the deadlines, etc., of when you've got to sell that property by.
Yep. Okay. Well, I think we could just finish off with a few questions that have come in. The first one here: is a UK will valid in Europe, in this case Italy, or will we need new wills?
In most countries, the will is going to be valid to a certain degree, although in a lot of countries, if you haven't said in the will that you want the European succession regulations to apply, then you'll only be looking at a certain proportion of the estate that the will can apply to, because there is a fixed proportion of the estate that has to be divided up according to their forced heirship rules amongst children, etc. So you have to be careful of that. If you've elected for the European succession regulations to apply, then that will can cover your whole estate. But then the danger of that is that the liabilities that might apply on some of the assets that you've got passing to people outside of the family, the rates are going to be high. What you would say is you should always have a UK will, and you should always have a will for the country you're living in. Normally, what you're looking at there is a will if you're moving to, say, Spain, you'll have a will for your Spanish assets, and you have a UK will for the rest of your assets. You're still going to remain liable to UK inheritance tax and UK succession law for your UK assets. And you're still domiciled in the UK, which is potentially means you're still liable in the UK to worldwide inheritance tax in the UK, and in the other country that you move to, potentially you could be liable there. So it's a real understanding the interaction between the sets of rules and how they may apply. You need to certainly, if you're buying a property abroad, is probably the lawyer that you've got dealing with the purchase can give you some advice on how that particular asset should be purchased, in what kind of regime you should buy it, jointly, whatever, how it should be structured. Should there be a usufruct or some kind of preservation there for a spouse? Because again, with forced heirship, the danger is that all the assets go to children. There's no provision for a spouse, or a very limited provision for the spouse. So all of those things you have to be aware of, and make provision for them generally in advance of actually buying a property. In most cases, you would always recommend that you get your own lawyer outside of any arrangement or recommendation from the property agent in the country you're buying in. Get your own independent lawyer, one for the purchase, but also to look at who can also give you advice on, how you structure it. Should you be putting a will in place? What should you be looking at if you're going to be moving there? Looking at what your asset base is and where those assets are located.
Okay, thank you. Looking at the other questions, we have in fact answered them during the course of the talk. So I would say just finish off by thanking you all for listening. I think I would emphasize that we have the individual sessions on the different countries, so Spain, Portugal, and France, over the next 3 days, over the next Wednesday, Thursday, Friday this week. So if you know where you're planning to move to, it's well worth listening to the specifics of those countries. I know some of you are planning to make the move in the near future, but others are planning in advance, and the longest, in fact, of the people registered is not moving till 2030. So it's good to see people planning well in advance. We're here to help you with your move abroad and helping your planning for that. So if you have any questions or like us to refer to any of our network service providers, please do not hesitate to contact us, expats@expatnetwork.com. If you want to contact Jason and his team, you can contact them direct or contact us and we will put you in touch with them. So, Jason, what's the best way of people to contact you?
We have a free phone number, which if you go to our website, you can see on there. We also have an email address that takes you straight into our inquiries team. So again, hit the website, blevinsfranks.com. There's loads of different download stuff there that you can get for free. We've also got a much more detailed book on each country that explains in very, very easily understandable terms the tax systems and what you can do from a planning point of view in France, Spain, Portugal, Malta, or Cyprus. There's immigration guides for each of the countries. There's other bits and pieces all on the website for free. The books actually are around about £8 each. Incredibly cheap for the amount of information in there. Very, very useful for you to have. Gives you much more background and something you can keep referring back to, and deals with that interaction factor that I talked about between the UK and the country you're moving to. So very, very worthwhile investment.
Okay, thank you very much. And I did miss just one question, but I think we have answered it. It says, does a civil service pension count as a government pension? The answer, I believe, is yes, is it not?
Yes. Yeah.
Yeah.
There's a huge list actually available. Just so you know, on the internet, you can look up what is regarded as government pension. Quite a lot of the NHS stuff falls outside of government pension, so that's something to be aware of. Which, once it's a government pension, you know how it's going to be taxed. It's going to be taxed in the UK, not the other country. But also, government pensions don't allow you to wind them up and obviously move the funds out. So there is that kind of restriction as well placed upon.
Okay, many thanks then. Okay, well, thank you everybody for joining us, and please come forward with any questions. We'll help in any way we can. Thank you very much, Jason. Thanks.
Bye bye.